What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is July 19th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to dispel some of the supposed bull market FUD that has been spreading around not only in the crypto space, but more broadly in the macro space when it comes to also equities. So I want to spend some time to talk about Bitcoin, talk a little bit about the altcoin sector, especially with all the hype around XRP and the recent case, and also take a look at the macro performance of both global equities as well as the monetary policy, because it always comes back to liquidity. We've also got a really interesting sponsored interview with Neptune Mutual, which is leading the way in fixing a major issue in DeFi insurance. So if you're either looking for one of the next hot trends for the next bull market when things get optimistic, or if you're in the DeFi space or have exposure to funds on centralized exchanges, you're going to want to watch this interview. So stay tuned for it. You guys won't want to miss it. If you enjoy the video, drop a like, and let's go ahead and kick things off. So I want to start here by talking about Bitcoin. While a lot of people feel Bitcoin is really riding high at the moment, we haven't been able to clear through this resistance range. We've been held back in since back in April. This is, again, the most critical price range to clear through in order to determine whether or not we've got any serious chance of actually maintaining a longer full-on bull market rally, right? We've had this great rally from the lows. I have no doubt about that here. This has definitely been a good sizable move, but it's not, again, the kind of returns we're looking for if we're really trying to ask the question of whether or not we've got a bull market. Plus, it's already played out. So the question you have to ask yourselves from here, if you're holding positions, if you are in cash right now like we are, and you're looking to potentially buy, you've got to ask that question of whether or not we can really clear through that range. Well, for the first time since back here in mid-June, nearly over a month now, we've had the longest red streak here on our daily momentum indicator. And while on the weekly time frame, we still are maintaining a positive blue flip here that's been maintained really since back here in January, with one anomaly here in May and June. Essentially speaking, outside of that 1 week period, this has been continuing to showcase here that the bulls right now are in charge. But if we essentially get down towards around 28,800, our indicator will likely flip red. And if it does that, that is likely going to be a prime opportunity to short, especially if we get 1 to 2 weeks of weekly confirmation in the red. So we're going to be watching for that here, especially as momentum has really stalled here. Now, Bitcoin, mind you, has been one of the best performers, not only in the crypto space, but of course in percentage terms against other asset classes. It's true, that's the case. Usually Bitcoin is going to be one of the fastest horses in the race, globally speaking, because Bitcoin is a much smaller asset versus, say, US equities or the housing market. But outside of that as well, it's obviously one of the more defensive plays within the crypto space. Altcoins generally don't lead. Usually Bitcoin leads first. Liquidity surges initially into Bitcoin, maybe more defensive plays like Ethereum, and then starts to float into the altcoin market. However, we are hearing a narrative now that altcoins are going to be the thing that carries it forward. It used to be just a couple weeks ago that Bitcoin was going to be the kind of spearheaded horse that was going to save the space. Well, now with the new SEC case, I'm hearing a lot of people making the argument that, especially with the move we saw on July 13th after the case, with XRP making the kind of moves that it did of 73% to the upside, and saying that the broader altcoin space did have some follow through then, now a lot of people are saying that altcoins may be the leader here, right? Especially seeing as we didn't see Bitcoin following through during that period in time, and in fact is actually trading a little bit lower from where it was trading at that point. So we've got to ask ourselves, can altcoins really show up to the plate? Is there any kind of juice to this narrative? Is there any substance? Well, at the end of the day here, guys, if we look at history, altcoins do not lead new bull markets. It just genuinely doesn't make logical sense. First off, you've got to consider the macro environment we're in right now, where we are in contracting monetary policy. Perhaps that will change, but as of now, we are going through a contractionary period in global liquidity. That is never good for the most risk-on asset class, mainstream risk-on asset class that retail and maybe some institutions, more likely hedge funds and family funds, may have exposure to, and that is altcoins, okay? So it just doesn't make sense on that part, but more importantly, it's important to understand the dynamics of crypto markets and how liquidity flows. Historically speaking, Generally, liquidity would flow into Bitcoin in the more defensive plays because essentially that was one of the limiting factors about crypto markets, that you'd have to go through a Coinbase or one of these kind of initial fiat on-ramps and then initially get exposure to these coins and then go trade, kind of Bitcoin or altcoin pairs. So for example, BNB to BTC or Litecoin to BTC or LTC to BTC. So name your favorite altcoin in the trading sum. We usually had to initially buy one of the more mainstream cryptocurrencies and then go to altcoins. That was the argument that people made. But in reality, the main argument here is that people usually, as newcomers, go towards the more popular plays, and as they make returns during bull markets, during the typical halving event, during all the exciting things, generally speaking, they would go and rotate into the altcoin plays, right? So that's generally, I think, if anything, the more substantive narrative here. So again, if anything, if we're expecting altcoins to really take off, we should expect that Bitcoin is leading the way initially, and it starts to pass that baton on to altcoins to continue much later into the cycle. That was the case, for example, in 2017. It was the same exact case throughout 2019 and 2020. Bitcoin led initially, really starting to lead the way, and then altcoins came in to take the lead in December of 2020. Again, if we really are in this kind of new bull market, as many people are arguing, right, we should not see altcoins having this kind of short-term advantage. We should see Bitcoin constantly leading. And either way here, irrespective if history is going to repeat itself, perhaps there's an argument to be made because you don't need altcoin pairs now, and a lot of the mainstream exchanges like Coinbase and Kraken may offer the ability to just outright buy altcoins through fiat. The argument here is important to understand, which is that price action is really not that exciting. After the supposed win by XRP when it comes to the case against the SEC, with the SEC's recent response, which doesn't sound too optimistic from their end, that they've effectively supposedly lost in this case, right? As the narrative has been spun around here, that it's a done deal, that there's no way the SEC is coming back from this, and that practically all altcoins are just somehow protected off of one judge's ruling, right? First, not to mention there's two different rulings in there, important detail to note about. But outside of all of that, put aside any opinions I may have, gotta be honest with you guys, the price action looks pretty bad here, right? Because in a crypto bull market, especially with news like this that is supposedly so optimistic, you should see altcoins give, and give for the next couple days off of news like this. This is the kind of thing that should, at a minimum, carry us up into this range if it really is as optimistic as it sounds. However, we faded practically half of those gains the next day and have continued to slowly but steadily fade down with no eager buyers coming in at this range. So again, this isn't really optimistic stuff, and technically speaking, if you just want to visualize it here, from that day we were essentially up only 5.5% for the broader altcoin market. That's not that impressive. It's certainly not bull market activity, even considering decaying returns, right? This has been pretty typical price action over a 2 to 3 week time frame in equities with all the optimism that's been going on there. We're not seeing that follow through in the most risk on, usually high returning asset class when things get good. But perhaps I'm being a bit cynical here. Perhaps it's I'm getting sidelined by just viewing the broader altcoin index. Perhaps there are some serious market leaders here. Well, let's take a look here at the largest by market cap. BNB, right? Binance's main token or coin is continuing to just barely scrape on the 200-week moving average. And while it had one of its biggest moves here, faded all of those gains practically in that same period of time. So unlike the other periods of time where in the past we didn't even come to the 200-week when we had capitulation, or back here in June of 2022, we had buyers coming at the 200-week, bouncing prices off and rallying them shortly after, we're just barely holding on by a thread. And it's not just BNB, right? Certainly XRP is definitely one of the leaders here in the altcoin space. If you guys didn't see my XRP video, I recommend you guys go ahead and watch it. Again, XRP has a history of doing some pretty deceptive things. But anyways, putting that aside here, take a look at Cardano. Cardano is actually probably one of the better ones here. It's kind of slowly kind of rolled down here over a couple of weeks, got a nice pop off here, and looks like it might maintain some of that momentum, right? But again, if it can't hold at this range, if we pull back, right, we can't hold on this white line. Next level here is all the way down more than 50% from that level, right? So it's not just here to look, it's not important to just look at XRP. You've got to take a look at a whole range of different altcoins and see whether or not we're getting some market traction. A lot of the plays, like the layer 2, kind of EVM compatible chains, whether it be Polygon, whether it be rollups like Optimism or Arbitrum, are really not showing that strength coming out of this recent news. So it shows us here that even if perhaps there may be a regulatory win here for crypto, the investor sentiment is shot. The imbalance between supply and demand is not shown up to the plate here. But again, as I want to step back here, perhaps altcoins are really not where we should be looking. Perhaps I'm being too picky here. A lot of people have been saying, Nick, okay, maybe you're a bit bearish on the narrative of crypto. But man, have you been checking equity markets as of recent? Equity markets have been continuing to climb here. And to be fair, there is some merit to this argument here. But I want to go ahead and bring your attention towards a critical chart. And this is one that holds long-term significance over the last, practically, not just the last couple of decades since back during the early 2000s, but all the way back since the 1960s. And this is the performance of the S&P 500 against the money supply. Now, one thing I have to say, guys, that has gotten to a really frustrating point for me personally. I like to talk and hear from different people in different parts of the aisle. I don't want to sit here and be a monolith of opinion. And I don't want to claim that I always get things right or that we've gotten things right? Equities have definitely caught us on the sidelines here. They've continued to climb higher. But it is important to note that when the times get good, you have to ask yourself, again, get back to that fundamental question of whether or not we've got the foundation to really accelerate higher. And I come back to this chart here because what has been frustrating me, like really frustrating me over the past couple of weeks and months, is how people choose to ignore liquidity when it is not playing out in their favor. What do I mean by this? When I say liquidity, I'm talking about the money supply. I'm talking about increases or decreases in the money supply, more specifically the decrease in the money supply. Because while equities have been doing well here in the near term, there have been a lot of exciting narratives around AI and all these things that are just going to transform the economy, even though AI has been, coming out here on nearly a year here in just a couple months. ChatGPT has been around for some time, Midjourney, all these great AI tools, some of which I think, again, over the next 5-10 years could really do some transformative stuff, serve some very great niche use cases, and may, yes, boost productivity in some areas. It is yet to materialize anything incredibly valuable, but the narrative is still riding hot here. And it's okay for equities to sometimes ride hot, even though liquidity is not matching there. In the near term, it's okay. In the long term, it's not. And I want to go ahead and bring your attention here to this chart. Long term, if we really take a look at it here, we can see that equities, generally speaking, at least the S&P 500, the 5 largest stocks in the market, essentially do not really expand away from the money supply. There are periods of time where it deviates heavily low to the downside from the median trend, and also as well like during the dot-com bubble, where essentially it goes to the higher end. Now, sure, you could essentially pull the NASDAQ here, which is going to give you a more optimistic version as well of this kind of chart, which generally maybe expands over time. There is a fair point to be made there that technology stocks tend to grow in a linear fashion in the long term. However, I want to go ahead and make it very clear here that it's very difficult to know when we are in growth periods if you're just going off of that chart. The important thing to understand here is that to find whether or not we're in a growth period on that NASDAQ chart, we've got to ask ourselves a couple questions. Do we have a solid narrative that is holding weight, that is producing revenue, producing growth, that is constantly growing? Because if AI is the narrative here, ChatGPT's growth last month was negative. It had 200 million less visits than the prior month after a month of stagnation the month before. And yet, we have yet to see a killer application, right? So if we take AI out of the equation, I mean, at that point, if you guys are really sold on AI and stuff, I respect your opinion, but I have to respectfully disagree. I'm trying to look about whether or not the major FANG stocks, which by the way have made the majority of the gains here, and many of which are not really directly exposed to any new innovative AI technology outside of the routine machine learning and AI that's already been implemented over the last decade, right? Seeing as they don't have any new epiphany in this industry, some new great technology, right? Maybe they're working on something behind the scenes. I'm looking to see whether or not the traditional FANG stocks are going to be doing well. And they have also made up a large portion of the S&P 500 here as an index, right? They make up a huge weighted market cap here of these leading companies. And whether or not their business models are really going to be able to generate more profit, more revenue over the next coming years, or if recessionary pressures are going to weigh them down. And if I can answer that question, I not only can answer whether or not the NASDAQ is going to continue expanding the upside, but also the S&P 500. And I come back here to this chart. I want you guys to just, I'm going to go ahead and draw this across here, just kind of help visualize it, right? Let's take it here to the quarterly chart. Let's cut out a lot of the noise. Above this red line, the only time the S&P 500 divided by the money supply has been able to get above this point was in the dot-com bubble. And it did so for about a 3-year period. That 3-year period is the only time in history since back here in the 1960s that equities were at this much of a premium versus the money supply. And in fact, looking in the more near term over the last 2 decades, since back in 2001, really over the last 22 years, every single time, 4 times in a row, when we got up into this range, it was where we topped out against the money supply. I have to say, for those who bought the dip in October, and to be honest, we're going to talk about why that was probably a good range to accumulate in the near term for a short-term swing for the year, right? Hats off to you if you got into those positions. In fact, if we turn to this chart, we can see that back here in October, we revisited towards a range here where we saw buyers come in October 2018. Roughly speaking, not the absolute lows, but it was generally a good time to accumulate in March of 2020 during the crash during COVID. Again, we'll take it here to the weekly. We can generally see here that, hey, if you were accumulating during this period of time where everyone was pretty fearful, you had an opportunity to make some great returns. And that's awesome if you happen to make that trade. But the vast majority of people didn't. The vast majority of people wouldn't have bought during that period of time. And it's important to note here that just because you might have missed that opportunity doesn't mean that buying today is a guarantee of anything. If anything, history tells us that we've got a couple more weeks, a couple more months in this range before things start to go south. The vast majority of the returns are over and done with here in the near term. That is unless the money supply starts to expand. We've got to come back to that fundamental question. Is the Fed going to start printing? Is the Fed going to start lowering interest rates again? The trajectory says otherwise, guys. We have got a long way to go from where we went in the year of 2020. We've got a long way to contract the money supply. The Fed is still running QT on autopilot down to new lows here. Now, I know a lot of people loved to talk about QE back when the banking crisis was going on. People love whenever there's a disaster, oh, let's hope on the Fed to come and save us. No matter the consequences, let's just have the Fed come in and print. Sure, the Fed's going to print a lot of money. Well, they did a couple $100 billion of supposed injection. The money supply wasn't typical QE. It was a short-term relief window for banking players in the industry, and they continued typical treasury sell-offs, mortgage-backed security sell-offs as per usual, and that brought us back down here. And a lot of that relief is also going to start wearing off soon, slowly but steadily. So you pile that in with QT that the Fed is running on autopilot. You've got a recipe to correct the money supply. I got to tell you guys here, you've got to be prepared. You've got to be willing to take some profits off the table. In my opinion, personally, not financial advice, but I have to say, guys, we are sitting pretty cozy in our cash position because we're not trying to chase some kind of short-term percentage return. We're looking to get in on the next bull market. And if Bitcoin doesn't have the steam to clear through this range, if altcoins aren't going to somehow magically lead the way and will continue rolling over rather than moving to the upside, and if the S&P 500 and stocks as a whole are getting overbought against the money supply, which is continuing to contract, reality will eventually set back in, and you got to be prepared for that. Anyways, guys, I've rambled on a good amount here. I would ask that if you guys enjoyed this video, if you made it this far, consider dropping a like. And I want to go ahead and dive into this really exciting interview with Neptune Mutual, because they're covering a really important part of the space. And we come back to this conversation of whether or not we're really ready for a new bull market. One of the biggest issues in DeFi is the consistent hacks, consistent exploits, and consistent issues that arrive with interacting with DeFi protocols and still with centralized finance players. We saw what happened with BlockFi, Celsius, FTX, all these names over the past couple of years. So it's good to make sure that you've got that insurance and that protection. So let's go ahead and dive into this interview with Neptune Mutual. All right, everyone. So in today's sponsored interview, I'm sitting down with Edward Ryle, who's one of the co-founders of Neptune Mutual, who's aiming to build a leading insurance protocol in the cryptocurrency space to protect those who have exposure to not only DeFi protocols, potentially also as well centralized exchange players like Binance. Edward, I'm really happy to have you on here today because I want to spend some time to talk about why it is so important what you guys are doing in this space. As someone who's a big fan of DeFi, I think it's important to understand this concept of insurance when people have large exposure to the crypto space. So thank you for making the time. I'm really excited to dive into our conversation. I think we've got a lot to unpack.
Sure, my pleasure.
Awesome, Edward. So I want to kick things off with just trying to understand what Neptune Mutual is. For those who are hearing about it for the first time, what is Neptune Mutual as a protocol? And more specifically, what is this concept of insurance in DeFi? Because I still think, even though this concept has maybe been talked about briefly, it really hasn't been broadly adopted in the crypto space. So I think it's a really big opportunity long term.
Yeah, I think so too. So firstly, Neptune Mutual is a cover marketplace, and it is in the DeFi insurance category. It's a marketplace where projects come and create their cover pools to protect their own community of digital asset holders. And it's a marketplace where owners of digital assets come to purchase cover policies to protect their assets. And it's also a marketplace where users can provide liquidity to those cover pools, which is then used to underwrite those risks.
Got it. Okay. So essentially speaking, for those who are getting exposure to various DeFi protocols, they're going to be leaning into these cover calls to essentially protect their position to some degree. So essentially, it's kind of an insurance policy on any kind of exposure towards any particular protocol. So you could do this for, deposit and lending protocols like Compound or Aave. You could do it for centralized exchanges if you had your funds custodied on there. Is that kind of the broad idea?
Yeah, well, it really depends on whether those projects come and create cover pools in the marketplace to protect their community. So wherever they do so, then users can use those cover pools and the policies that those projects have created for their communities. Users can come and buy cover, whether that's smart contract risk cover or custody cover in the case of CeFi projects, of which we have a couple who have already set up cover to protect their users against the risks of frozen withdrawals for a certain period of time.
Very cool. And on this point, like Edward, like we probably both know that DeFi is probably the biggest use case in crypto. But I find it amazing, like years later now, since back when I really got kind of honed in on DeFi since 2019, we see constant hacks, even during the bear market. There's constant risk in this market. Anytime you're engaging in a transaction, you sometimes don't even know what you're signing when you're engaging with a DeFi protocol, or it's not really kind of written in plain English. Isn't it obvious that this should be a killer use case for DeFi long term, or at least it should be a part of the broader DeFi ecosystem? But I think right now it's a fraction of the market at the moment, if I've got it correct.
Yes, well, definitely. I mean, there are many risks, as you said, and a lot of these are big risks. In 2022, $2 billion worth of DeFi assets were stolen. And I think all of those that lost $2 billion of assets will probably be particularly interested now in DeFi cover. And those reading about some of these losses, I would imagine also should be interested. And that is one of the reasons why myself, Binod and Gillian, the two other co-founders of Neptune Mutual, put the project together, because the blockchain space is risky and it needs better and more easy to use and more reliable solutions to mitigate those risks.
Yeah, I'm curious to kind of ask you as well, like, why is it, right? So far, people haven't been really taking those positions. You even still sometimes have like some pretty big LPs who haven't opened positions yet on some of their positions in, say, Uniswap or other AMM protocols. I'm really curious to hear what's kind of the biggest hesitation or maybe misunderstandings that people have around insurance. And I'd love to even kind of follow up on that with asking about like, what can the average cost be, for example, for someone? Let's say I'm a large player, I have a huge exposure to compound, and I have a stablecoin position of DAI or USDC on there. What's that average cost going to look like on an annual basis, or how much will it kind of eat into maybe my yield that I would generate on the protocol?
So answering the second part of your question first in
Mm,
relation to the price of cover, in the case of the marketplace, users who come and have a look at our application will find that there's a floor price and a ceiling price for cover policies. And so the way that works is that the price is dependent primarily on utilization of liquidity of that particular cover pool. So where there's very low utilization of liquidity that has been provided to the cover pool, users are encouraged, if you like, to purchase cover because the price will be near the floor price, so
mhm,
relatively cheap to buy cover policies. Where the capital is used up in that cover pool towards 100% utilization. So those cover policies become more and more expensive and go towards the ceiling price. And that drives liquidity providers, so users who are looking to provide liquidity to cover pools, to provide liquidity to those cover pools where there is high utilization and where the capital is most needed, because LPs in our marketplace are rewarded with the stablecoin cover policy fees paid by those who purchase cover. So that's a little bit about the dynamics of the pricing.
mhm.
And in terms of answering the question, why isn't there more usage and adoption of DeFi cover? Well, that is a really interesting question, and one I wish it was asked more frequently in the mainstream crypto media. And I guess there are a number of points around that. I suppose the first is that DeFi insurance protocols need to do a better job of creating scalable models that respond to the needs of users
Mm.
in a way that is kind of reliable and fast. And at the same time, users need to be asking themselves two questions, which is how how probable is a risk, and what is the consequence, and how much pain am I going to suffer if that risk occurs? And that mindset is something that people are used to, not necessarily in blockchain, but they're definitely used to. So when you get in a car, you put your seatbelt on. Why do you do that? Because the consequence of not putting your seatbelt on is getting wrecked through the windscreen in the
That's true.
case of an incident arising. And you don't want that to happen. So the question you need to ask yourself is, how many digital assets do I have at risk? What's the probability? And should I put a seatbelt on my digital assets? And when people start asking those types of questions, I think we'll see DeFi insurance grow enormously.
Yeah, I think to that point, it's such a minuscule cost for such great protection over this asset class that either usually generates really great yields or has this future growth potential. And for me personally, I have to say, like, we used to kind of focus on bringing users into the DeFi sector. We had an application that integrated into Compound, and I was looking for solutions like this on the market. It's so imperative to have this kind of option, especially for the everyday person who really the first question we would always get asked is, do you have FDIC insurance? That would be the first thing people would ask because people, especially know in crypto, out of any market, you've got to be careful and make sure that there's some kind of cover policy that's going to protect you. But speaking about that, you kind of mentioned the term risk a couple times. And as you mentioned, it varies across the crypto space. The way that someone interacts with Compound as a user could be very different from Uniswap. Sometimes funds are within a smart contract. Sometimes you're just interacting with a contract. So I'm really curious to hear from you. What types of risks can be covered in the marketplace? What can you get covered calls to protect essentially? Maybe some examples would be kind of cool to see how it might look for a couple different DeFi protocols.
Sure. So we have, firstly, two different types of risks that are covered at the moment in the marketplace. And those are custody risk, and those have been created, those policies have been created by CeFi projects that want to reassure their community in a way that is very difficult for them to do by themselves. So by creating a third-party cover pool where the payouts are determined by a third party and the amount of protection is clearly defined by a third party, it's much easier for them to build brand resilience and protect against liquidity runs on their exchange by placing that cover as a third party. So we have OKX Exchange and Binance Exchange custody risk policies. And that's obviously for custody cover. On the other hand, we have smart contract risk, and we have a whole number of different cover projects that have cover policies available in two different types of pool. One is dedicated and another is diversified. And I can explain, there's plenty of YouTube and video tutorials that we have which explain the differences between those pools. But custody and smart contract risk are the two main types of risk. But what I would say is that we are a marketplace, so it is the cover projects that determine what types of risks they want to cover and how the policies are written. And the policies are there based on user demand. So if users want different types of risk covered, then they really need to reach out to their projects and ask them to create a cover pool in the marketplace that addresses and mitigates those specific risks that they want covered.
Yeah, I think there's a huge win-win to this, because if projects go out there and take the time to create these opportunities, they inevitably will bring more users, more liquidity, more kind of, I think, more risk-off participants who want to play things safer, make sure that they hedge their bets. And one thing that's been great, Edward, is that you guys have seen some really solid growth so far. I mean, you guys have been kind of building behind the scenes, building up the initial ecosystem. But, what's so great about Neptune Mutual is that you guys have already had a great amount of adoption. You're on multiple chains, especially Arbitrum has been grabbing some traction. So I think that that's really exciting to see that you guys have been doing so well, especially in a relatively kind of slower period in the crypto market. I think we're getting potentially ready over the next year or two to see that next wave of DeFi. And with potential new protocols coming out, I mean, this is going to be a necessary thing. We can't repeat a lot of the mistakes of the last few years. But the first thing that kind of comes to mind here for me, Edward, is, we talked a lot about some of the CeFi players that went under over the past few years. We had a big cleansing in the crypto space. And just now, I mean, even still to this date, a year or more later, we're still seeing projects kind of going through the claims process. So I was really curious to hear, when it comes to a DeFi protocol, what does that process look like? Because these things can sometimes be really lengthy and they can be complicated and just really just add a lot of stress to users after already kind of getting hit from a hack or, some kind of exploit. So what does that look like for users?
Well, that really is the reason that we adopted the parametric model for our marketplace, because it is very scalable in terms of the way we address the problem of what happens when an incident arises, which can impact many, many people all at the same time. And so the way parametric works is there are no individual loss claims. We only assess the incident. And when I say we, it's the Neptunite community that assess incidents. So that can be done relatively quickly. Typically, we have a 7-day incident resolution process and a 1-day cooling down period. And what that means for projects is that when something bad happens to their protocol, their community can get payouts within or following 8 days of an incident first being reported. And that's really, really important in an environment where news travels fast and sentiment travels fast, if you like. So changes in sentiment happen very quickly and impact others and can snowball. You need to sort these problems out fast and in a way that is fair to everybody. And this parametric model enables that. You can resolve incidents quickly, and you can do so in a way that once the incident is declared as either having happened or not happened, in either case, either everyone with that cover policy gets paid out or nobody gets paid out. Right. So you don't have this issue of discretion where some people do, some people don't, and it depends on what they put in their individual claim and exactly, No, it's just
Yeah,
keep it
there's no
simple.
like no like a larger users or
Exactly.
smaller users or what price you paid. I think that's really cool that
Exactly.
it's very like clear and straightforward. And again, correct me if I'm wrong, Edward, but when like I went through and I was checking the UI before you actually buy a cover call, you can read the terms. It's relatively clear about like in the event of X, Y, or Z happening, you're able to have protection over any funds that you get protected under the cover call. So it's relatively clear. You get those terms clearly. It's not some kind of guessing game to what you're actually going to be covering.
Well, the requirement to scale DeFi insurance is clear for everyone. The risks are huge and there's
Mm,
lots of them. And we need to have solutions that are scalable. And scalable means a lot of different things, from the parametric approach that we've taken to be fast, to get people their money quickly. But as you rightly say, solutions, DeFi insurance solutions, need to be simple, they need to be clear, and they need to be reliable, because people are paying for this service. And so
yeah.
if they get hit once, by an instant. They definitely don't want to be hit twice by not receiving what they're expecting to receive when they have been paying policy fees to protect themselves. So simplicity is important, and it is one of the factors that drives, we believe, scaling this solution to mitigate risk.
Yeah. So I'm curious to play like, kind of a scenario here, Edward. So let's say, for example, I mean, ideally, the way people would use the protocol is they're just paying it out and nothing happens. That would be the great scenario. But let's say something does happen. I mean, we just had Euler Finance back a couple months ago had a hack, and there's another bridge hack on Poly Network. I mean, it's just hacks every couple of weeks. There's some multi-million-dollar hack in the crypto space. Let's say one of those protocols that there was a cover call offered for, gave users protection, but it got hacked. What would happen to Neptune Mutual? And even also as well, you guys have like a native token for the protocol, NPM token. So what would happen to these elements if, there was a cover call request from its users who wanted to enact on that kind of option essentially to reclaim their funds?
Well, again, that's a good question. And it is really important for users to understand the relationship between Neptune Mutual and the risks that are being covered in the marketplace. And the answer to that is essentially nothing happens to Neptune Mutual when hacks arise and incidents are validated or not validated within our marketplace. And for the simple reason that Neptune Mutual isn't involved in the marketplace itself, other than
Mm,
having some kind of selection over those projects that come into the marketplace to ensure that they are solid, relatively secure projects and so on. But it's users and projects that provide underwriting capital for the cover pools. So that's the first thing. And the second thing is that our token doesn't play a part in the transactions within the marketplace, in the sense that policy fees are paid in stablecoin, and payouts to LPs are paid in USDC stablecoin. So that's an important element for us of financial stability within our own marketplace. So that's to say the Neptune Mutual token, the NPM token, doesn't influence and isn't influenced by what happens in the marketplace. So that is really important and is a differentiator between ourselves and some of the other players in the marketplace, that are more hands-on in terms of
accessing
raising
and taking
underwriting
that
capital
risk.
with their tokens.
Yeah, they
Exactly.
can exactly. They're more exposed directly to it. I think everything, essentially, from my understanding, of course, there's the governance process, but essentially everything, once a new cover call is deployed, it's done through smart contracts. It's in a decentralized way. So that part is relatively trustless, and then it moves on to the governance to step in and assess that situation to see if the cover call can be enacted on. I wanted to kind of ask you a two-part question, Edward, like, because I mean, really, like, as someone who's been following this industry, I first found out about Bitcoin in 2011. I really, however, got really invested in the space in 2016, 2017. And with DeFi now, I feel for the first time we have like a really cool use case outside of just store value. It's now being able to take these digital assets that have fixed or deflationary supplies and using them as digital kind of commodities or collateral to go out and do incredible things and potentially bring in more stablecoin liquidity and do things that we can't even imagine here today on our call. But I'm curious to ask you, from all the hacks that happened over the last few years, what has been learned from these centralized exchange hacks, DeFi hacks, and also as kind of a second part to the question, from what you guys have learned over the past couple of years building this protocol, how are you preparing for the next couple of years? I'm kind of curious to hear whether it's a roadmap or like just your guys' vision long term. How do you see Neptune Mutual standing out and really becoming the Uniswap equivalent for the DeFi space when it comes to insurance? I think that's a really big goal long term, but I think it's something that's desperately needed.
So the first question, I think the learning points over the last 18 months or so, perhaps I'll maybe simplify the answer, which is that I think it's really important for projects and users to understand that there's a difference between approaches that lower risk, which are really important, like getting smart contracts audited, having penetration tests, doing all the sorts of things in terms of security that you would hope and expect projects to do, and mitigating risk. They're two different things. So we talked about seat belts earlier, and when you get in the car and make that decision, should I put a seatbelt on? You don't say, has this car been audited? Do I know that the brakes work correctly? You don't say, do I trust the driver? Is the driver, a safe driver? And then you take the decision about the seatbelt or not seatbelt. Those things are separate. So you would hope and you would want the car to be audited. You want the driver to be a safe driver, but that's not going to stop an accident happening.
No.
So accidents happen. And so lowering risk and mitigating risk are two really different things. And I think it's really important for all projects to take that on board. You mentioned Euler, and I think, Euler were particularly, how can I say, they were naturally upset about the fact that their smart contracts were hacked, given the quantity of audits that they put in place.
Yeah.
Now, all credit to them, they also had insurance, so they did both lowering risk and mitigating risk. And I think that's a lesson that everyone should have, which is you need to do both, because just lowering risk by itself, not having a seatbelt on, it's a really dangerous approach. So that's the first thing. The second thing is how can we drive growth? And I guess there are various answers to that. Firstly, we have an epic tech team led by our CEO, Bynod, and they just keep executing on new projects literally every month. So they rolled out a bridge UI for our users last month. This month, we've launched on BNB. We've launched an NFT loyalty program, which is going really well. We're planning on launching on more L2s, and we're having lots of conversations with new L2s. We have a massive NPM emission reward program for LPs, which is coming out in a month or 2 months' time with vote escrow NPM. We have liquidity gauge pool. So the tech team are building and executing, and I think that's really important. That's to say, just keep building, keep delivering new projects in order to drive growth. And we are, now that we have a lot of these projects out there in the marketplace, and we have some traction, the marketing is now building in order to make people aware of all these projects that we have coming into play. So hopefully that answers the little bit about the second part of your question.
That's awesome to hear that you guys have such good velocity here in the bear market, because unfortunately so many projects will slow down during these periods of time. But I always like to focus in on projects that are accelerating, they're maintaining good consistency, they're delivering updates on their projects, doing more biz dev. But outside of that, as well, as you said, a big part of it is that education piece, because it is great that a lot of protocols, and I hope it'll get to the point where not only these protocols offer the covered insurance, but that through their user interface, through their ways that they interact with their community and their users, that they will, not essentially push, but they'll essentially inform people that this is a risk, and you cannot just essentially lower risk, you can mitigate it. Essentially making sure that if people want to pay it, here's the terms, it's clear, this is the protection you get if everything goes south. And I think as that happens, you guys have built the foundation. It's just a matter of time, over the next, I think, year or two, as this space kind of starts to mature and evolve, and people realize, as they deploy I think, a substantial amount of capital. A lot of recurring users will come back who were hacked, who lost funds, who took excessive risk. They're not only going to come in with, again, that idea of lowering risk and trying to be more street smart, but if they have that path forward to just completely mitigate the risk, I think that is something that people will be willing to pay for. But yeah, Edward, this is a wonderful conversation, man. I was just curious, like, we always try to, at the end of the interview, for people who made it this far, they're obviously interested in what you guys are doing. I'm personally really interested as well. I want to keep up with it over the next coming months and years. I was curious, for those who may be interested, where would they go to learn more about Neptune Mutual? I know that there's a couple different resources, maybe like the website or Discord.
Sure, we're on most of the social media channels, obviously. So as you said, Discord, Twitter, Telegram, but definitely follow us on YouTube. So we are ramping up the amount of tutorials because, as you rightly said, education is really, really important. There is lots to understand. And so we are doing our best to produce more and more YouTube content. And that's really one of the channels which we hope to expand over the coming weeks and months. We've already started, and that's just going to build. So if you follow that channel in particular, then that will be a great starting point to get to know us and get to understand what we're about, and as a starting point to joining our community.
Man, and I have to say, if you guys haven't already, I'll leave the link down below in the description to the YouTube and Discord. As Edward mentioned, I recommend you check out the YouTube content. They've been kind of doing a refresh on it recently, but I mean, even the prior videos that you've done, Edward, are awesome, man. He's got a better studio setup than me, so I'm a bit envious. But Edward, man, I just have to say, it was a really great conversation. I think this is so needed in the space. I'm really keen to see more people bring adoption towards what you guys are building and starting to implement it in their kind of DeFi strategies. But it'll be interesting to see really like what kind of covered calls will be able to be open over the next coming years. I think what we have now, you guys have covered a lot of the space, which is awesome. But I'm interested to see what kind of protocols are going to come out. And with that innovation, you need to have that kind of mitigation of risk on the side as well, which is where you guys come in. I think that's great from a business development standpoint, and it's going to give you guys a lot of room to grow. So I'm keen to have you back on the channel, or maybe talk to Byron as well, or other team members on the team, and definitely keen to continue tracking what you guys are doing down the line. I really appreciate you coming on, man.
Well, thanks. It's been a pleasure, and we'll definitely make a date, put another date in the calendar, and we'll check in with you perhaps later on in the year, and we'll see how things are progressing. But hopefully, like you say, adoption's on the up, and it's a really, really exciting sector with, I think, huge growth potential. So yeah, looking forward to it.
Awesome, Edward.